Morning and welcome to Fast Market. It's Thursday, December 13th. I'm Tom White, joined on set by co-host of Fast Market, Kevin Hincks, and also by Scott Bauer, CEO of Prosper Trading Academy. Good morning, guys.
Good morning.
Hey, I'll tell you what, this market is kind of a little jittery right now. I think it's all based on headline news. We're up, we're down. I don't think you can make much sense of this because I don't think a lot of investors can.
About 45 minutes ago, this market kind of lost its bid right around 9:13 Chicago time, and it slipped to down on the day, but now it's firming. As we come on the air, the futures have firmed a little bit off their lows.
Yeah, basically unchanged. We've got the small caps down about 0.5%, Scott, but do you contribute yesterday's late afternoon sell-off from highs in the S&P 500, basically, to lows of the day by the end of the trading, right ahead of the PM vote over in Britain, in the UK? Theresa May got confirmed, but at the same time, do you look at this as a market that the investors have to really pay attention to as far as if it gets overbought or oversold either way?
No, what I look to, Tom, is what you said about 90 seconds ago, is that the market is completely trading off of headline. Regardless whether you're looking at commodities, oil space, whether you're looking at equities, whether you're looking at interest rates, doesn't matter. The market is completely trading off of headline risk. And that is the good and the bad about the market right now. Right. Fundamentally, it's really not a good thing because for, someone that wants to get in this market for a longer time makes things really, really difficult, right? For the day trader, it makes it fantastic because it's keeping this increased volatility in the marketplace. So you have the push and the pull there, but really, really difficult right now to make any sense out of technicals or fundamentals.
Yeah, and I talked about this with O.J. Renick on the Morning Trade Live show, Kevin. And if you're a long-term investor or a trader, is this good or bad? I mean, S&P 500 and Dow are both down 4% this month, so it's giving you opportunities to get in if you're a long-term investor.
Yesterday's final hour of trading should be a master's thesis on uncertainty and what it does to futures prices and what it does to the overall market.
Because we were going along pretty well yesterday afternoon.
Right, and then the news started to swell about a no confidence vote, and it was coming right as the market was closing at 3 o'clock Chicago, 4 o'clock Eastern, right. And then uncertainty just gripped, and the news media got a hold of it, and they were churning it around, and it just kept. If you look at the final half hour of yesterday's trading day, there was just a flight to safety, almost out of the futures. But then the vote came out. It was actually a pretty overwhelming vote of confidence, 200 to 117. Futures firmed up overnight. Now there's just a little more two-way trade. But that last hour yesterday was a textbook on what uncertainty can do to futures.
Yeah, I think you take a look at this market, Scott, and you mentioned that you look at duration as far as investing in this. If you're a trader, or we're now negative, if you're a trader or you're a long-term investor. And like I said, we had some rebounds in some of the industrials yesterday. Boeing, Caterpillar were driving the market up. The FANG Plus names were really positive throughout much of the day until the late sell-off. But now you're starting to see this where if people are uncertain, if investors and our viewers are uncertain moving forward, into this, do you just kind of push it aside, or do you take that into context where they're selling rallies now instead of buying dips?
Well, that's exactly it, Tom. And the market is a case study in psychology. And when things are volatile, when things are uncertain, psychology tells you the first thing people do, it's negative, right? I mean, that's just human nature. So what we're seeing in this marketplace now is every rally being sold instead of every sell-off being bought, as we were just a few months ago, which is just complete flip-flop of the emotional trading that we've seen this year. I mean, this whole year, years from now, is going to be an incredible, incredible case study, Kevin, like what you just said about yesterday's trade. This whole trading year is going to be an incredible case study on how the market was really opposite, divergent of the normal type of trading pattern.
Yeah, and Scott makes a good point here, Kevin. The divergence from the positive economic data that we've seen and the way that the market
across the board with no let up in economic data. Even today's numbers, right? The initial jobless claims, crazy low, and all the forward-looking numbers. But, you know, I've never seen anything how rhetoric can affect a market so strongly, so across the board. And what it does, it causes hesitation. But I think some of the things that happened this week were extremely healthy for this market. Like, case in point, it was Monday during the trading day when we broke 2,600, stops, took the market a little bit lower, and then it firmed and rallied from there. I thought that was significant. In terms of the lesson for this week that I see was that breach of 2,600 and then the hold above it. I think that's put a little bit of a floor on this market.
And Kevin and I talked about that that base where we saw maybe some stop losses and then it rebounded, Scott. But I've been kind of pounding the table on the fact that the market action that I'm seeing, the way that I'm looking at it from my experience is telling me that we're not done going down to that level where people are going to get comfortable. I've been calling for that 2550 in the S&P 500 moving forward before we actually find a base, and then you're going to probably get the bulls to come out. But do you see that happening, or do you see this 2600 level being a floor?
I actually see this area right here as being somewhat of a floor. I say that for two reasons. One, if there was still that sentiment out there that we're going to have that capitulation or we're going to have that massive move down, we'd probably see the VIX trading mid to high 20s, not where it's trading right now. And even Monday when we did dip below 2,600, I don't think VIX ever got higher than 23, 24, which, yes, that's elevated, but not probably where it should have been based on that. Now, looking at the chart here, if we go back to the ES chart here for a moment. Now, this is very short term, but look at Monday's low, then midday Tuesday, yesterday, and look where we are right now. It's a 4-day period, but we're making higher lows. Right? We're making higher lows and, you know, a little bit higher highs. Now, again, the very short time frame, but something that maybe is going to materialize.
Yeah, but if you're looking for something to reinforce your bull trade, right? You're starting to see some signs of something that at least you can sink your teeth into.
Instead of lower highs, which we saw throughout October. Right.
Exactly.
And that was the market action then. We'll have to wait and see on that. But I kind of wanted to turn to the commodity space. I wanted to look at oil, guys, because oil is now up 0.5%, and it was down basically 1%, down 0.5% to 1% earlier in the session, based on some data that we got out of the IEA that there's still potential for significant oversupply of crude, and they don't know the effects that the OPEC plus nations and their production cut is going to have on this oil space. But we're still in that tight range, Kevin, between 50 and 52.5 a barrel.
You think OPEC sits in a room sometimes and go, we need somebody to start a rumor?
Sometimes?
Sometimes. We need someone to break this supply thing. Somebody start a rumor about
But that used to be the news. It was whenever Saudi Arabia or OPEC came out and said something, the oil market reacted accordingly. And now it seems like with production in the U.S. leading the way now, and Russia number 2, and Saudi Arabia number 3, that doesn't have the weight that it used to.
I really think this action on crude oil you can almost look at it like an earnings event, right? And the market wanted 1.3 million or above, and they didn't get it, right? They got 1.2, and that it feels to me is keeping just a little bit of a lid on crude oil. It didn't get what it wanted, just like any earnings event in this environment.
Yeah, and Scott, before we came on, probably 10 minutes before we came on air, oil was still down. It popped, but you said you saw a little bit of news on crude oil, which made it actually rally back to positive territory.
I did. I think what I saw was EIA coming out and saying that actually there still may not be enough supply out there.
Okay.
So maybe a little change of rhetoric there. I also saw some news maybe about a half an hour ago that I think Venezuela was either going to be offline a little bit more, or the production was going to be further cut from what's already expected in, which would pull back, supply a little bit. So we see the little pop. But just like every other asset class across the space, whether it's equities, whether it's bonds, whatever it is, we're seeing most rallies being hit with sell orders.
But here's the bigger question that touches on Scott's point. When you're trading commodities, rumors. Right? Rumors that either do or don't come to fruition. But if you're in this space, if you're trading this commodity intraday, you have to deal with it.
Yeah, and you make a good point there. As an investor or a viewer, there's a reason there's different levels that you can trade, and commodities being one of them. You have to have a higher level of experience or knowledge in those products to trade them, because they do trade that way, Kevin, right?
Absolutely. Oh, believe me. Trading the grains, since 2006, every year it's some type of rumor coming out that you get like a mid-season rumor that changes the direction on
So isn't that the reason why, especially in the option market for commodities, you see the wings always bid up, which is different than in the equity space, because the market does trade on those rumors.
And you see the skew the other way.
The skew is the other way.
To the calls. Why? Because uncertainty makes commodities go up, makes stocks go down.
And you make a good point there. Having those wings, and what Scott means by that is having inventory to trade those rumors and the bigger than expected moves in there based on the headline risk, right?
Have the
little
bullets.
puts grow up to
have the bullets, right?
Little puts grow up. I used to call them liberators.
Yeah.
When everyone would come in and sell little puts, I'd buy them. They're like, what are you buying those for? I go, these are so I can sell the big ones when they come in.
And you make a good point there, because when we traded down on the floor, guys, as market makers, I always had bullets in every product that I traded, and especially in the SPX.
Units.
Because, it cost me money because I was long units if we were in a dull market. But at the same time, you needed that protection.
Sure.
And if it's cheap, that's the time to buy. And in the commodity space, we see that on the wings, on the outside, those out-of-the-money calls, out-of-the-money puts that a lot of professional traders are long. But I kind of wanted to move over to economic data, guys. Kevin, we had weekly jobless claims, which you mentioned.
206,000, extremely low. They were looking for 228. That brings the 4-week average down to 224. So remember, we sat on this show about a week ago and talked about the creeping numbers for weekly jobless claims.
They were going up.
Yeah, this blows that number out of the water because it's back down to 206.
Now, remember that, and Scott, maybe you can hit on this a little bit more, is that the November jobs report wasn't as robust as a lot of people said, but that was probably forecasted by those weekly jobless claims numbers. Now, remember, we did have some fires, we did have some storms.
And and this is why you take the averages.
Yeah.
Right? This is why you don't over-invest in one number.
Can't do the one-offs.
No, it's just not. It doesn't give you a true. These numbers. What do we learn? Look at the import-export prices. These numbers can get volatile over time. So you've got to look at the 4-week average. That's what I'm always looking at. And the 4-week average, because of this number, went down 4,000.
Yeah, and we did have import and export prices. They dropped 1.6% in November. Food and beverage prices down 2.2%. And then you also have petroleum energy costs falling as the price of oil fell. So those numbers a little bit weaker than expected.
It was like CPI yesterday. You had rising costs pretty much above the across the spectrum, and then all neutered by gasoline.
Gasoline and apparel
down
prices.
4%.
Apparel prices were down 9%. So that, I mean, as far as economic data, guys, and this might, kind of reaffirm that stance that we have, that our economy's healthy. Unemployment rate. Here's the question. This is just a poll. Not scientific by any means. Where do you think this unemployment rate gets down to if it goes? It's at 3.7% right now. Scott, just give me not a forecast, but maybe where you think it might bottom out.
I think we're there.
You do? Okay.
I think we're. Let's put it this way. I think we're within a basis point or two of being there. So let's call it 3.5, 3.6.
Okay.
Yeah.
And I'm in that same boat, Kevin, but I've been hearing from pundits and from market watchers that
everyone will throw a number out at
3%.
Yeah. Hey, guess what? If we get interest rates firm and trade with China better and we get some of this uncertainty out of this market and first quarter earnings come in better
than expected, yeah.
You could get another leg up in this market and you could get another little downward draft in unemployment. Absolutely. It's all about how these employers look towards the future. Right? The forward-looking numbers are vital.
Yeah, you wonder if the next unemployment number, if it's down a tick or two, down to 3.6, 3.5% on the unemployment rate, if that's the apex, like a lot of people called earnings this past quarter, the apex of the growth or profitability for.
Actually, they called them the second quarter. Remember, those were the peak until this peak came in.
Until the next.
And now this is the peak. Looking at the lower next one until the next one comes in. It's kind of a rolling peak.
Everybody's the expert.
It keeps going higher.
That's right, and they've been wrong for the past 2 quarters, but maybe a quarter and a half. So we'll have to wait and see on that, especially heading into earnings season next week. We will talk about some earnings later in the show.
Here's the last thing. One last point. The expectations for next quarter, 13.4%.
Yeah.
That's setting up pretty low.
Oh, yeah.
But if economic data starts coming in better than expected, like it has, do you think that number is going to rise? Those estimates will rise?
Well, I mean, when the numbers start hitting, because think about it. The banks will be first, right? I think you've had a pretty good trading quarter out of the banks.
Yeah.
You've had rates going up, right? I think so. That could be the kind of the genesis of a wave here. Remember, those banks come out first, and it'll be interesting to see.
You know what? And Kevin makes a good point. I kind of wanted to hit on this, Scott. The banks have not participated at all.
The opposite of participating.
And they have not turned around. My idea is that's why I keep on expecting, or maybe putting it off a little bit, that we're going to see 2550 in the S&P 500 because it doesn't seem like the banks have bottomed out. Treasuries are are higher, yields are lower, and that's not being conducive to growth for some of these banks. And until they turn, I don't think this market's going to be on firm footing.
Well, I think the big downturn we've seen in banks has been all because of what you're saying there, Tom, and it has been because there's now been this cap on rates, this, that, and the other. But what I think what we're not really looking into, and we'll see this on their report, is that the trading revenues, much to like what Kevin was just saying, trading revenues in the Goldmans and the JPs, et cetera, they have got to be blowout numbers, at least compared to where they've been over the last year because of the extreme volatility we've seen in the last 3 months.
And volumes have been picking up not only in the option market, but in the equity market also. But I kind of wanted to pivot over to, as we weaken here a little bit, markets are starting to fall. And that Russell 2000, Kevin, I looked at it earlier, it's down nearly 1%. We're seeing financials weaken there.
Something new today. Financials are weak. Oh, great.
Energy was weaker, but also consumer discretionary was weak in that particular space, according to the Thinkorswim heat map. I was looking at that a little bit earlier.
Don't say that the financials aren't participating. They are participating.
Just the wrong.
They're the nail, not the hammer, though.
All right, let's turn to earnings, guys. We wanted to hit on Adobe because we finally get some big names with earnings this week.
Yeah, we've been starved for good names.
Starved for good names here. So we've got Adobe basically flat on the session, trading about $245. Shares are still up 40% for the year, Kevin, but are about 11% off of 2018 highs. And I believe we talked about this yesterday. The team from Likefolio.com, Andy Swan, gave us some information that maybe their data was showing that we're seeing a peak cycle in Adobe, which has been growing over the last 3 years as they've converted over to the cloud-based business and the subscription-based model.
Pretty good looking chart there, but this chart, this last, a month and a half or 2 months?
Yeah.
Pretty indicative of the overall market.
Down 11% from those highs of 277.
And look at, you always go back to look at the first couple, October 1st, October 3rd, Jerome Powell statements. You can pretty much peg the top of all these stocks right to that date. Yep. It's amazing how every single stock is hit the same way.
And if you look at the overall market at that start of October.
Jerome Powell wants his name on that sell-off?
Well, he quickly turned. He did a 360 on his comments, hawkish to dovish, relatively quick.
That told me all I needed to know.
Right. All right, so let's take a look at Adobe. Sorry about that. We're expecting a market maker move of only $10, Kevin. That's only about $2.50.
Yeah.
That seems extremely low in a particular name like this. Scott, your take on Adobe going into earnings?
Well, number one, we have to remember that it's only one day.
Yep.
Right.
We're on a Thursday, so there's only one day. That being said, if we go back to the charts there, you will see some decent support in the stock in the low 230s. You'll also see some decent resistance around that 260 level. Those numbers almost correlate directly to the move.
Yes, good
So I look
point.
at something like
Look at
that,
this.
and I look at something like that, and even before I see how the options are playing out here, I want to play that range. If the reward to risk is there for me, I want to play that range. Looking at something like an iron condor, because I don't know whether this is going up or down, and I don't see anything here that really indicates bullish pattern, bearish pattern. I see this kind of range-bound area. So if
Maybe that's why the option market's pricing that smaller than expected.
It's not
move,
coincidental.
because it typically moves 4 to 5% post earnings. We've seen some big earnings moves in this particular name, Kevin.
Scott Bauer is correct, though. Look at all the activity down around the 235 level.
Yeah.
How many candles there have stopped right around there?
Yeah, we've only seen one break of it over the last 9 months or so. But if you're looking at an iron condor, now this is a high volatility type trade. You're collecting time decay. It's risk defined in nature. How much duration do you go out? So if I typically initiate an iron condor in, say, an index like the SPX, I'm looking anywhere from 40 to 60, 70 days out from expiration. But now we have earnings. How far as duration goes, do you look?
Typically, if it's just for the earnings play and not a longer-term projection, I'm going to look for just this week.
These 14 weeklies.
The fact that there's only one day, though, that I won't say complicates things because it adds a little bit more risk, but also should add a little bit more reward. I'm going to look at just the one day, then I'm also going to look at next week's also to see how much more premium I might be able to collect getting that extra week.
You make a good point there, Scott, because with an earnings event, we can have an outsized move and then it normalizes.
And then exactly.
So what if it goes down $20, but then starts rallying back up as analyst upgrades come out? Maybe they dig into the numbers a little bit as far as that. So going out a little bit further might help that. But Kevin has created an iron condor. Scott, let's walk us through this. He's selling the 257.5, 260 call vertical and selling the 235, 232.5 put vertical. It's $2.50 wide on both verticals. There's the Analyze tab on that so that you get an idea of what that looks like as far as break-evens, profit, and loss on it. What are you collecting on that, Kevin? 90%?
About 90, what did I say, 90
94,
some
95
cents?
cents,
Yeah,
like
right around 95 cents. So 94 cents is trading about 93, 94 on a $2.50.
So if you collect 95 on that, $2.50, you got to subtract that. So about 155 in risk on that particular trade. Are you comfortable with that risk because your verticals are outside the range, Scott, right?
But both of them, I gave it about the range plus a half dollar a dollar.
Exactly. So what I'd like to do is just compare that to what the commensurate iron condor for next week would be. Now we know the range is going to be bigger.
Exactly where I was going on this conversation.
And that's why I said commensurate. So we have to move our strikes a little bit.
Right.
Because that expected move to next week is probably an additional few dollars.
Now,
exactly.
You can just change it right there, Kevin. Just go to the D's at the top there under the X.
Yeah, but we have to change the I think we have
you're
to
going to change the strikes
Change
too.
the strike.
Yeah,
Okay.
because here's
you're
why.
You're going to be able to widen it out because you got another extra week.
And here's why. If you go to the right column, and we talked about this at Scott's event that he had on Friday, look at the expected move. $11.60 versus $15.40, another $4.
Yep, and that's based on the 7 extra days that you have, the duration.
Exactly.
So let's redo it, reset up the same iron condor, but let's go 8 days out now and do the same thing, but we'll use this expected move. So we'll go down to probably right around 230.
Yeah. That's probably a good idea.
230, 227.
You can look at the probability of that finishing out of the money is 78% on that short 230 put.
And then we'll go.
High probability of success.
Let's be a little more aggressive here. We'll go with maybe the 260. Now we'll go 262.
You can go 262.
262.
And that's 83% probability.
Now there's 84 cents.
But what's the trade-off? And we always talk about trade-offs here, Scott, is you get to widen out the wings of this iron condor, the short verticals, to give you a better range, but you have duration and you have less of a credit.
So which is the better here? Now, yeah, Tom, you're exactly right. We're a lot further out on this one, but it's only costing us a dime to do it. Not a bad trade-off.
Right. So what I would do on this one, just given the technicals of what we saw and kind of giving that the trader's spidey sense, I'd actually raise the put side one strike. The reason being is because we saw so much massive support.
You mean closer?
Closer, right, to make it the 232.5, 230.
I like it.
Because we saw so much massive support in that range there, that's going to bump up my credit a little bit.
And you're comfortable with
now
that,
look at almost the exact same one.
Yep.
There we go. Now we're up to 92, 93 cents.
And
that's the one I do.
And you can actually change your credit too. If you expect volatility to expand into the end of the day, you can actually raise your credit.
Put it out there at 95, put it out there at $1. You can always adjust it. Those are the strikes I would use. That's the setup I like.
All right.
Now here's what we're going to do. We're going to do both.
Put that in 3 times.
We're going to do both and run a little test here. We'll go back to the Analyze tab. We'll call up the other one that we had.
Yeah, that's the one for 95 cents.
And then we'll create duplicate order there. See, you can do both here.
Yeah, and that way we can go over both of these tomorrow post-earnings. All right, we got a couple iron condors in there, neutral strategies, taking advantage of time decay, high probability of success. All right, Scott's going to join us later, but coming up next, it's Face Off. We're taking a look at technicals versus fundamentals.